Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Mutual fund and long-term investing heavyweight Baron Capital is launching 5 new actively managed ETFs today. So joining me now, fresh off ringing the opening bell at the New York Stock Exchange, are Ron Baron and Michael Baron from Baron Capital. Gentlemen, thank you both for being with us here on ETF Edge. We appreciate the time.
Thanks for inviting us.
All right, so maybe we'll start with the news, gentlemen, first. And Michael, I'll turn to you for that. 5 new ETFs, actively managed, but they're not typically what we think of as actively managed in terms of maybe some of the levered funds that are out there, defined outcome. These are actively managed from a portfolio perspective based upon your fundamental views of the portfolio companies. So why ETFs for Baron Capital?
Sure. There's a lot there. Let's unpack that. In terms of why ETFs, nothing at Baron Capital is changing in terms of our investment philosophy or investment process. This is purely an extension of what we've been doing in terms of managing commingled portfolios for growth equity investors. We've become known as the preeminent growth equity manager based on our performance over the past 43 years. But we have a mission in terms of changing lives for our clients. And in order to do that, we need to expand beyond a singular focus on the mutual fund. We've spent the past year and a half, 2 years, really understanding ETFs, understanding if we can deliver our investment philosophy and process in that wrapper. And today I'm excited to say we feel that we can and have. Clients know us, they like us, they want to utilize us. But there were things that were missing, whether it be about operational efficiency, tax efficiency, transparency, and intraday liquidity. And we feel that we can offer our same investment philosophy and process in this wrapper and deliver on those various factors.
Now, Ron, same was the key word that I kind of got there from Michael's response. These ETFs are not different than what you guys have always done with your core portfolios, right?
Same process.
Same process. So take us through why or what the investing philosophy is for you guys and why it translates well into both a mutual fund and an ETF format.
Michael talked about how we're trying to change people's lives. That's the mission we have. The mission is not to make as much money as we can, as fast as we can, and go do something else. We love what we do. It's almost a hobby. I guess it is a hobby. So all the things we do are based upon being long-term investors in businesses. That's how we have chosen to change lives. And we have actually been successful, that our record is the best of any mutual fund company in the United States. So 97, 98% of our assets beat the market. 60% are in the top 5% of funds. And Baron Partners Fund is the #1 fund in the United States since 2003. And so the reason for that is that we made $57 billion in profits so far. And I think that over the next, starting with $100 million in 1992, and we're hoping that we can make 5 times that over the next 10 years.
Again, if you take a look at the track record, it's one of the reasons why people are attracted to the Baron Capital type products. Ron, I guess maybe the follow-up to that is, do you feel as though the investment philosophy that you've evolved over the course of the last few decades still maintains that same kind of momentum power in terms of investing for the future? And how exactly have you evolved your investing philosophy over the years to identify the star companies of then, and then more recently, some of the star companies like Tesla and SpaceX these days?
Well, we're investing in what companies are going to become, not what they are at this moment in time. And so we have to, if you want to rely upon other people's advice, you will never outperform. You'll be the same as everyone else. And so what we do is we do our own research. We have 212 people at Baron Capital, 45 are analysts and portfolio managers. Portfolio manager are actually senior analysts. And what we do is we visit companies every day. Companies come to visit us every day. We talk to them every evening, every morning, every day. And we try to learn about their businesses. What I've described it as is that we take a company and we rip it apart in our heads and we try to understand and then put it back together again. And we try to find out and understand about what it is that makes that company distinct and different than others and gives it an advantage that other people can't duplicate. For example, in SpaceX, that what they distinguishes them, and they're about to go public and again in, I guess in next June is my guess. And what's different about SpaceX is they've been able to have a rocket that can use over and over and over again. No one else has been able to do that. So other people would use a rocket one time, it could cost $100 million. Right now it costs us maybe $10 million to get to space. It will cost us very soon $1 million. Elon thinks it's going to cost less to go to space than it will to go from New York to London. So it's an amazing revolution, and nobody can catch us. So because of that low cost to space, what that has enabled is to have 10,000 satellites providing Starlink services to every inch of this planet. So basically, you can now get broadband anywhere because of Starlink. NetJets, I've been trying to get NetJets to use Starlink for 5 years, and they had to get this regulation. They had to, but basically, the head of NetJets sent me a note, I guess 2 or 3 days ago, and said because of, I've been doing this 5 years, because of you and several others, we're now installing NetJets on our planes, on 600 planes, 50 a month, and we would go places, and you would lose communications. You can't do it on NetJets. When you have a Starlink, you'll be able to do this everywhere. So one business that has distinguished us in Starlink, in SpaceX, is Starlink. 10,000 satellites, going to be much more. There's 8 billion people on the planet. 3 billion don't have the internet. We're going to give it to them. That's number one. Number two, they've just announced fairly recently that we're now going to go and build data centers in space. All you read about now is data centers, how expensive they are, 3 or 4 or 5 years to build. It costs several $1 billion, $4 or $5 billion to build. And shortage of energy, shortage of land, permitting. And what we're going to do now is we're going to put them in space. So now cooling is a huge cost. Put them in space, no more cooling costs. Put them in space, no more electricity costs. So basically, you're running it for power for free and cooling for free, which are enormous expenses. And one of the companies that we've invested in as well, another Elon company, is XAI. And what they're going to do is use these satellites that they have, this network, going to be 1 million satellites. 1 million. Now we have 10,000. So now it's going to be 1 million for providing this data center in space. And XAI is going to be a main beneficiary of that to provide services like ChatGPT, but better.
Now, Michael, all of these investing ideas come about because of a rigorous research process. And you guys are fundamental stock pickers. I mean, that's a generic term. But in essence, what you do is you do a good amount of analysis. You have teams of research analysts and portfolio managers trying to hunt for these opportunities. How exactly does the research methodology at Baron Capital lead you to some of these things? As somebody who's learned from Ron and who's progressed through the ranks, through the analyst stage, and through to where you are right now, what exactly then do you look for in terms of what makes a good investment?
Yeah, there's a lot that makes a good investment. And what's different, it's what makes a good investment to Baron Capital. We have a team of around 45 investment professionals constantly searching for what is a Baron Capital type investment. What's a Baron Capital type investment in not just technology and growth, where people assume, but what makes a Baron Capital investment in financials and in healthcare and real estate. We want to have a diverse portfolio and different ideas, really understanding these different companies. Like he was mentioning, tearing them down to their essence and rebuilding them, making sure they make sense, having different points of view, asking different types of questions. Understanding who the management teams are, what makes them, where they've had successes in the past, where they've had failures in the past, where their motivations are in the future, and then packaging it together to construct a portfolio that we can now deliver in an ETF. You were asking earlier, what makes these different than other ETFs out there? There's a ton of ETFs. There are now more ETFs today than in publicly traded companies. How does this stand out? We feel that there's been this mismatch. There's been not enough of true fundamental stock pickers, people that build foundational portfolios for long-term investors. And that's what we're trying to deliver by finding these research ideas, packaging them in the portfolio, and now structuring it in an ETF format.
You mentioned, Ron, people. It's a continuing theme among many of the investments that you have engaged in over the years. People is an important aspect because people are the ones with the ideas, people are the ones implementing these types of business models and plans. What exactly is the secret for you on finding the people that you think are the ones that you want to invest in?
You're trying to judge people's intellect, passion, leadership skills, knowledge about industries, unique ownership of a business. We want to be in the same boat that they're in, and thinking about the individuals who are running those businesses, whether they are running them to benefit themselves or to benefit all the investors as well as society in general. So we're trying to understand the personalities. Where do they live? Where do their children go to school? Do they work? What's their lifestyle like? How long have people been tenured at their business? How come? So we're trying to understand all the different aspects about how business operates and what are the weaknesses and strengths, and be very thoughtful about, nothing straight up. And when you see things that are straight up, and it's the same increase every quarter from a year ago, what most likely you found is a scam. And so what we're trying to find are companies with open-ended opportunities. I was writing in one of my quarterly reports that Cliff Greenberg and I had a client a long time ago. It was Fred Stein, and he used to talk about dimension as one element that separated out one business from another. You can say the same thing for individuals, but there's something special about him that you can just say, boy, that's someone who I would like to bet on. That's someone who I trust. That's someone who I believe is going to run a business in the best interest of the executives who work at that company and individuals who work at that company, as well as for the society they're serving with the products and services they offer.
Ron, one of those people that have fulfilled and checked many of the boxes that you just mentioned is one that you've been closely associated with for the past decade plus at this point, and that's Elon Musk.
15 years.
15 years now. Elon Musk, specifically with regard to investments, as you point out, in Tesla, SpaceX, which is now the biggest holding that you have. You mentioned you invest in XAI as well. The Elon Musk story is an interesting one because he has become one of the people that has been maybe the figurehead of American technological innovation over the course of the last 20 years. What exactly is it about Elon Musk that first drew you to investing in him as a person and then the companies that he manages?
Oh, he's brilliant. That's obvious. And when we first met him in 2010, when he was going public, we thought we'd like to invest with him, but I thought it was unlikely. We thought it was unlikely he was going to be successful, where he's doing a couple of thousand cars a year, and he thought that he could do 20 million cars a year. And it didn't seem reasonable, but we continued to, after meeting with him for a couple or 3 hours the first time, we continued to follow him, visit him, talk with him regularly, and the executives who worked in his company. In 2014, when it became obvious that his cars were meeting very strong demand, we invested between 2014 and 16, $400 million, and we made about $8 billion in that so far. And then 2017, we were following SpaceX all along. In fact, when I was in the 1960s, I worked in the United States Patent Office. I chose to work there instead of going to Vietnam. I had a draft-exempt job. Sounded like a better deal to me. So when I was there, my art was chemicals. I was a chemical graduate in college. And so I was the person who in the 1960s gave patents for all the coatings that went on nose cones that wouldn't burn up when they came back to Earth. Anyway, so 2017, I started doing research in the 60s. And in 2017, we began to invest in Tesla, in SpaceX, and we've invested about $1.5 billion so far, and that's now worth about $10 billion. And we think that it's likely they could go public next summer sometime, and the valuation has been reported in the press. It could be $1.5 trillion valuation. Right now it's $800 billion. A week ago it was $400 billion. So how come? What separates them apart? What separates them apart, I attended a board meeting. They asked me to come to New York to meet with a number of board members about, a few weeks ago. And we were talking about Elon and how young people, they are just dying to work there. And so they have about 120,000 people and maybe 30,000 hires a year. And to get 30,000 people, there are several million people apply for 30,000 jobs a year, several million. And then the chairman of Tesla was telling me that they come there. We were asking about what do they come here for? And he goes into these meetings. He'll take 30 or 40 young people or senior people in any one discipline that they're working on, whether it's software, whether it's hardware, takes them into a room and for a couple hours and goes around and talks to everyone and asks them questions about what they're doing and keeps getting deeper and deeper. Initially it's general and deeper and deeper and deeper. And then at the end of the meeting, the people walk out of that room, especially if they're first-time engineers. They walk out of the room and they're shaking their heads and say, "Can you believe what we've learned? Can you believe what we've just heard? I am so glad I survived that meeting." So basically, the people who work there are saying they come there because they want to work with this person. Now, of course, the early on, if you're investing in Tesla, it's a great risk when you're relying upon one person like that. But now when you have 120, 130,000 people and the business is growing exponentially, no longer linearly, then what happens is as you get larger and larger and larger, the risk of one person diminishes. And what you've invested in is a company with a culture. And the culture is what we try to discover. This first principles is all about. What you're trying to discover is what's been instilled in these people, that he gives responsibility to talented people, and talented people unleashes them. And if you got a better idea than what I thought was the best idea, show it to me. And if you can prove that it works, even though I just invested 20 or 30 or $50 million in another way to do it, if you show me something better, we'll throw that out and start all over again. And so he's not afraid to fail. And basically that's what he does over and over again. So you're looking for personality traits among these people in whom we're investing that make it likely they're going to be successful, in our opinion.
If I could just follow up, you mentioned that you think your best guess, in your words, is that SpaceX goes public sometime in the summer of next year. You said maybe June earlier on.
I was thinking June 28th because that's his birthday.
Okay, there you go. I like that. I like that there's a target. We can kind of coalesce around that. So in your opinion, that's when it happens.
Well, they've said it to their shareholders.
Now, you have a valuation as well. What do you think the valuation will be for SpaceX as it approaches kind of that anticipated target for an IPO date?
Well, it's $800 billion now, and the press has speculated that it's going to be twice that amount next summer. This happens to be, of our investments right now, it's our largest investment. We have about $10 billion invested in that, in SpaceX, about $5 billion invested in Tesla at market. So Tesla right now is selling at $460, $470, $480, something like that. Our cost is $12. And I think we're going to make, in Tesla, I think we're going to make 5 times their money again over the next 10 years, maybe more. And then in SpaceX, I think, I've been wrong so far about how much we're going to make. So my number is here, and Elon's number is here. So we'll see. But I wouldn't bet on me.
You would not bet on you, but I think a lot of people are right now.
Well,
Michael, a lot of people are right now. Best ideas is something that Ron just mentioned, kind of this idea of challenging what could be and coming up with an alternative. Well, hey, what's the better idea? When it comes to Baron Capital's portfolios, as somebody who's running some of that money right now, where do you think those best ideas are gravitating towards these days? It seems everything is about AI and technology. But when you kind of dig a little bit deeper, are there certain parts of the market, thematically speaking, that are catching your eye a little bit more these days as a portfolio manager for Baron Capital's funds?
Yeah. We feel like we need to have a diversified portfolio. Yes, AI is in everyone's tip of the tongue. And that's what's worked over the past few years. So much of the market has been left behind, especially companies, small and mid-cap companies left behind. We just launched that first SMID, small and mid-cap growth portfolio. Great valuations, especially they should be working as interest rates come down. But there's more to it. It's companies that are investing in themselves have been extremely penalized. Investors don't like to invest. They don't like to invest, penalize short-term earnings, have that hit as earnings come in, and that multiple also comes in. So it's a double whammy. We love that because we're able to find those companies, understand what they're able to achieve, invest in them at great valuations, and see that through to the life cycle. Two companies come to mind that had been investing themselves are now realizing it. Guidewire is one of them. Guidewire has shifted everyone from on-prem software to the cloud. That's come to fruition. More companies are signing in, not only signing in, but taking on more modules. IDEX, same kind of thing. This is a company, Pet Diagnostic Systems. They develop more tests. Took them a little while to develop the test. They launched one this past year. We think they're going to launch another one next year. You're seeing more usage and earnings increasing and valuations increasing as well. But there's still a lot of companies in our portfolio that are investing in themselves and penalized. So right now it's a great time to be investing in those businesses and letting them come to fruition if you're a long-term equity investor.
Gotcha. And a follow-up to that, there are 5 ETFs being launched right now. Any aspirations for expanding that family of funds, and what exactly would you look at potentially to expand those offerings?
Sure. We have 5 as of today. I want to get these 5 right. That is our focus, is getting these 5 right before doing a next wave. I do anticipate us doing more, but let's get these right and then take it from there.
Ron, did you ever think in your life that you'd be sitting there, a storied Wall Street career, did you ever think you'd be at the top of the podium, ringing the bell, the opening bell at the New York Stock Exchange, and launching a listed product at the NYSE? Just what kind of a feeling was that for you, and in terms of just your perspective on how it's affected you as a person and your family overall?
Well, you said you're a Jersey boy.
I'm not a Jersey guy. I'm a California guy. But I married a Jersey girl, though.
Okay,
sure.
And so you've been to Asbury Park?
I have.
And that's where I grew up. And so think about the boardwalk in Asbury Park and Convention Hall on the ocean. And that's my background. And then getting to be on the New York Stock Exchange, a listed company, it's sort of unbelievable. It's the way I think about it. Unbelievable. My life has been unbelievable.
What exactly do you think that next chapter will be for you?
For me, I don't see it as being a next chapter. I just keep the same thing. So I think that over the next 10 years, I expect our business to be much larger than it is right now. As I said before, I thought that we were going to make 5 times again. So we made $57 billion in profits to now, over 40 years. I think we're going to make $250 billion in profits in the next 10 years. So I'm excited about that on behalf of the employees at Baron Capital and on behalf of our investors. And you know, and there's so many companies that are interesting right now that have been left behind with everyone focusing on technology. One of my good friends is the chairman and founder of MSCI. I love MSCI. I love Henry Fernandez. And he says that one of the characteristics that we have that's rare is that we're able to see what isn't yet present. And MSCI, so our cost in MSCI, we invested in it when he founded it. He escaped from Nicaragua when there was a coup, came to America penniless, started MSCI at Morgan Stanley, brought it public in 2008. He said we were responsible for allowing him to do that, for enabling him to do that. Came public at $10 or $12 a share, went to, or maybe 15, went to 30. The market crashed, went back to 15. We kept buying, and now it's 600. And I think the opportunity for MSCI, they're buying in their own shares, and he's been buying shares as well personally, which is, he says he's trying to keep up to us. I'm trying to keep up to him. MSCI. And there's another one, FactSet, that we've been an investor in for a long time. We weren't able to invest in Bloomberg. This is like Bloomberg, that, was a way that we could invest. So we've been an investor in, I don't know, 10 or 15 or 20 years, and we made multiples of our money. And the stock is down this year. And what I think is really interesting, do we have a couple more minutes?
Absolutely, please.
So there's been a change in management, and a young man who was brought up in India on a farm, impoverished, went to the top IT school in India, went to the top engineering school in India, was a consultant and got a job as a consultant for McKinsey & Company, then came in the financial crisis in New York when he was 33 years old. He was brought to New York with whatever kind of card you get, and he was advising Geithner and all the people to prevent the whole economy from crashing. He's 33 years old, from crashing. And then he gets recruited by Morgan Stanley, by JP Morgan rather, and he's one of the top, there's thousands of employees there, he's one of the top 10 people who's being considered to succeed Jamie Dimon. And he makes it into the top 10. And then he doesn't, he's not going to be the successor. He says, okay, I'm leaving. Where does he leave? He goes to FactSet, and where FactSet had a new search, and he's now the new CEO. And I've been telling Michael, I said, Michael, think about if you have a company that is this really cool company with great opportunities, like a Bloomberg, but I think young and up and coming, and you have a guy like this, a killer guy, is 51 years old, or 52 years old, and think about you put Jamie Dimon at 51 or 52 years old in charge of this company. That's what just happened. So basically, you find companies like this, you find people like this who run these businesses, say, I have to invest with that person. So we came out of, we didn't, the stock is in half this year. So basically, but because of, a number of different things that aren't continuing. And so we're very excited about that. But across the board, whether it's hotels, whether it's real estate, whether it's financial companies, whether it's consumer products companies, you can find them everywhere. And so that's what's really exciting to me right now, that we have this portfolio of very exciting, super fast growing companies that are risky. Then you have 30 or 40% of our portfolio. Then you have 50 or 55% in these good, solid, double-digit growth companies. And then you have 10 or 15% in companies that are penalizing current earnings to become much larger in the future. And those are companies that last 10 or 15% where nobody wants to invest in those companies until it's obvious about what the company is going to produce. We invest in those companies for a portion of the portfolio, which is one of the reasons we performed so well for so long.
I could go on for hours, literally, Ron, with you and Michael here talking about investment philosophy and ideas. I wish we had more time, but please come back and see us again soon. We'd love to have you back, Ron, Michael.
Thank you for having us.
Thank you for your ETF Edge inclusion in your program. We appreciate it.
Thank you very much, Ron and Michael as well. Now, my thanks to both of them. We've asked both of them to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thank you very much for watching, and we'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.